Good afternoon, everyone. This is Rich Torbinski with the Mortgage Collaborative here once again for the last week in Mortgage Today. Each week, I am pleased to be joined by one of our lender members as my co-host. And this week, thrilled to be joined by longtime friend, TMC member, the president of the St. Louis mortgage market for People's National Bank, Chris Sims. Simsy, good to see you.
Hey, Rich, how are you, bud? It's good to be here. Glad
Doing
to be on
good.
today.
Absolutely. And yeah, thank you for joining me this week. And before we go ahead and get started, I want you just to level set for the audience. Tell us a little bit about People's National Bank, the mortgage division within it, and anything unique or interesting you guys got in the hopper here as we get into the heart of 2021.
Yeah, no, definitely. People's National Bank is a small privately owned bank out of technically Southern Illinois, but we kind of have two regional corporate offices, I would say. So one's here in St. Louis, and the other is down in Mount Vernon, Illinois, in Southern Illinois. We've been a $1.3 billion asset bank looking to try and step into that St. Louis footprint and getting into some growth that direction. So because of that, they wanted the opportunity, recognizing that mortgage could be a nice entry into not only deposits and commercial relationships, but being a way that, especially with street origination, you can start building a footprint and a naming brand, so to speak. So, but 3 years ago, they sought out the team that we have, which is my head of operations, Tammy Kapp, and Josh Smith, who's head of capital markets, and myself, to come in and build a mortgage group. We had done it for couple other groups and been really successful at it. And so it was an opportunity for us to kind of do that again here. And the beautiful part was they let us start with the operations side first. So we built the operations group, got our technology in place, got our infrastructure up and going. And then from there, started looking to build the sales side, which was perfect because it rolled us right into last year, right? So had a great, picked up, averaged about 10 LOs last year, doing $225, $230 million in total volume. So it was a good mix. So looking to continue growing it from there.
Awesome. Congrats on the success last year and doing it the right way. And let's go ahead and get into it. I'd like to start with just a look at some of the notable news headlines that have emerged over the course of the last week. Some of note: March existing home sale data came out, down 3.7% in March from February. That's something we normally don't hear in the mortgage industry. Normally we see existing home sale data increase as we get into the heart of spring. Some items of note within that release: the median average home sale price versus a year ago, up 17.2%. The total housing inventory stock from a year ago, down 28.2%. Just when you think you've seen it all in the mortgage industry, your reaction to a pretty unique existing home sale report last week.
Yeah, completely. And I think what was really interesting too is that how much it differed from the coast versus the central states, right? The Midwest still had an increased value compared to, or an increased tick up compared to the coast were both down. But collectively, and we've been seeing that here. I mean, as we're getting applications coming in from across the country, it's amazing the amount of relocation and due to the effects of COVID. And if you think about it, if you're living in a 1,000 square foot apartment in LA and trying to have the California lifestyle that's been shut down for the last year, you're paying $3,500 to $4,000 a month. You can move to St. Louis, and for $3,000 a month, I can give you a 4,000 square foot house sitting on about 3 acres, and you'll be loving life. Your taxes will be much cheaper, and we've still got quite a bit of lifestyle here, and we didn't quite shut down near as much as everyone else did. So, you had the opportunity to be closer to home, especially if you're from the Midwest, and we started to see that millennial population coming back in. So, yeah, even much as I was shocked a little bit to see that it was a decline for March. At the end of the day, you started breaking down the numbers and getting into the middle of it. And you saw that, well, yeah, it really kind of was coming from the coast as people are trying to get out of some certain environments and possible regulation and things might be coming, or increased taxes, the whole 9 yards, to areas that might be a little more favorable. I mean, look at what Texas is doing right now, and especially with some of the tax laws they're trying to create and some of the uniqueness that's going on in the Midwest in general, trying to bring both corporate and individuals back into the middle states.
Yeah, absolutely. And I think, some of the Midwestern states like Missouri and Ohio are doing some unique things to get people to move to their states, like proactively. Like, I was out in California scouting the property for our upcoming summer conference, and I saw a billboard on one of the LA highways, like, move to Ohio. It got me curious enough to start looking into it. And yeah, it's a huge initiative by Ohio Governor Mike DeWine, reaching out proactively to some of those states you mentioned on the coast, like, hey, come move here. You could have a much nicer lifestyle with far lower taxes. So
Well, and you think about it too, when you look at from just how our economy has been based over the last couple of years, things have been dramatically changing with the U.S. becoming a net exporter of oil and not necessarily needing to be a net importer. The opportunity to start bringing blue collar jobs back to the States and seeing that engineering, manufacturing, and everything else coming back this direction is definitely been a major shift. And Ohio and Missouri were both two states that in the crash saw huge sufferings. The auto plants shutting down significantly in our areas, and that not only hurt us from a real estate side and economic basis, but at the same opportunity, we just couldn't get corporate infrastructure back in. And now all of a sudden, when you look at especially the way the coastal states have kind of imposed some pretty hefty regulations going on, that all of a sudden the middle states have got a pretty good opportunity to take advantage of that. And I think they're all starting to do that from both a policy standpoint and also from a tax policy standpoint, which is making some changes. We're seeing a lot of companies moving into Missouri, and that growth has been huge for us. And that's helping real estate, it's helping home values in general. It's helping the average wage, the whole 9 yards. So.
yeah, as you mentioned, another trend seeming to indicate that there will be at least some minor population shift away from the coasts and into lower cost, more middle of the country areas. And it's just going to be fascinating to me inside the housing industry and just more broadly, some of the tailwinds, some of the things that will change as a result of the pandemic, just in our country in general. Certainly stuff we'll continue to keep an eye on here on this program, especially as it relates to the housing industry. Moving on to another interesting report that came out, single family housing starts. So this is a monthly report that comes out that essentially is a gauge of shovels in the ground, new digs on new builds of new residential construction products, down 13% in April as compared to March. And again, normally we see these numbers start to go up as we get into the heart of spring. Again, within that report, some interesting stats. I think 15 to 20% of the builders surveyed flat out said that they have foundations that are down, that they are not doing anything with strategically. More anecdotally, I've seen another couple of reports and columns written, interviews and talks with home builders across America. And essentially what they're saying is the demand obviously is there for new homes, even in inflated prices, but it makes no sense for us to continue to build homes at our regular pace right now with what we have to pay for supplies. So I think another indicator that we're not going to see the relief to the inventory issue through new construction, at least not to the degree we need it. And another interesting report that came out, your thoughts on the housing start report last week?
Yeah, no, completely. You look at it, you got several different issues playing into it, right? You had supply chain shortages. You had, you got the issue, just there's no land, right? Ultimately, that as people are trying to find land to dig the holes into, and then trying to get the supplies in. And what's a contractor going to do? He doesn't have the ability today to come in and order the supplies and let it sit there while he's trying to get everything done as much as they would like to. But even your big track builder side, who tends to be able to order things in bulk, they've had a major shift. We've got a home builder here locally in the St. Louis marketplace that literally controls 50% of the market share. And they've seen a significant issue that direction. So then you add in labor. I mean, trying to find the skilled trades labor in the marketplace has been just a completely another difficult scenario. I think it's time for home building to really see some major innovation and change coming. Whether it's manufactured walls like through the SIPs, or it's modular home builds that can be built inside the factory where the environment can be controlled a little better, and the opportunity for those homes to still be green and efficient, but also have the opportunity to get to a home site much sooner and quicker. And then you don't have the labor being forced out in the elements. They're able to work in a controlled environment. It's 70 degrees, and you're not having the weather effects on that. So I think there's some major innovation that needs to come to allow that opportunity, but that also comes from the lending side too. That means that we in the lending side need to step up. And in the banking side, it's a little bit easier for us to do the construction lending side, right? We get to hold our own lines and take advantage of our ability to lend from our own in-house warehouse. But collectively, the opportunity to create an additional marketplace would be interesting to free that up and make it more available. If the consumer had the ability to get better access to financing, I think we could see that a little bit differently too. But without the labor shortages and the material shortages that we've got right now, and the fact that a 2x4 costs a little over $850 here in Missouri, it's going to be tough for those guys to continue the pace, much less trying to increase that. The demand's there, that's for sure. That we have no issues with the demand. It's truly being able to supply and have the availability of a workforce to cover it. So
you make a great point about the construction finance side of the industry. As you noted, a lot tougher for independent mortgage banks to write construction loans. Obviously, banks can do it. There's some limitations there if it's interest rate risk or just loans you hold in the portfolio, liquidity risk. So banks can only do so much fixed rate construction volume. Nobody wants an adjustable rate construction loan right now with 30-year fixed rates in the high 2s or low 3s. And and when we talk about like Fannie and Freddie and get them out of conservative and all that, like I know for a fact Fannie and Freddie, like prior to like all the Mel Watts stuff that went down that led to his exit at the head of FHA and then obviously going into Calabria, they were working on and were very close to exactly what you mentioned. And that would be a more industry friendly construction lending product that would mitigate some of the interest rate risk. That got derailed. And we know eventually America's been underbuilt for, depending on who you talk to, 5 to 10 years. We have a record inventory problem right now. So there's going to need to be a lot of homes that need to be built once the supply side gets sorted out. And it's going to be interesting to see how the construction finance part of our industry evolves with that greater need.
Completely agree. And I think ultimately you don't have the opportunity for low to middle class to enter that space either, right? So we don't have the ability for lower income families to go out and recognize a new home, even in areas where there might be land available and the opportunity to come in, but you don't have the companies moving in, you don't have the manpower there to actually build it, or in many cases they don't even have the financing ability. And like you said, they definitely couldn't handle the adjustable rate side and the fluctuations. And then you get back to the Fannie and Freddie trying to do a single close, and when that loan truly has to be validated in that process towards the end, and what that circumstance could look like for those individuals can get really hectic and tough. So yeah, I think there's a lot of change that does need to happen, not only around the lending side in the space, but also just in what we end up considering as an opportunity for new construction. Right now, if you're going to do a new construction home, you're definitely in the upper 3s to 400,000. Matter of fact, I don't think the home development here in St. Louis that's under 250 that I can think of. So for new family just coming out of school, might have graduated both as teachers and making $65,000, $70,000 a year, struggling to get into that new home development. So how's that going to work, right? Much less the opportunity for communities that might have lower income and the opportunity to get into a new home. And I think the Urban Institute just pushed something out the other day about, if you truly want to change the landscape for low to moderate income families, it's truly home ownership and the effects and opportunities that come with home ownership. So in St. Louis, I know that most of our low income areas tend to generate about 60% rental income as opposed to a true home ownership. So if we had the opportunity to switch that up, what would that look like for those communities, those towns? And ultimately, what chances will we have as a industry to kind of, bring some change to that overall deal if we had better financing, we had more opportunity and the labor force there to do it. So.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by the president of the St. Louis Mortgage Market for People's National Bank, Chris Sims. And Chris, I'm normally not a big government guy. I think at times it seems like it on this show because of, I think, my opinion that the need for government intervention, assistance in cases for the housing industry has made sense, going all the way back to the government's bailout of Fannie and Freddie, which many people were so adamantly against, ended up being absolutely the right thing and a wildly profitable endeavor at the end of the day for the US government. And I do think that it may take some government intervention here as it relates to new home construction in America, this inventory issue, what we're seeing with values right now, bidding wars and no help in sight on the inventory side. I don't know if that is through Fannie and Freddie. That certainly won't happen with the current director of the FHFA. If it's through, regulation or tax relief for the home builders that are basically saying it makes no sense for us to build under a $400,000 house because of the costs, the regulation. And what you said is totally valid. Why should a couple people making $50,000, $60,000, $70,000 a year not be able to build an affordable home in America? And why is the new build market start at 400,000, like even in the Midwest?
Right.
Any thoughts on the potential cure for this as we move into 22 and beyond?
I tend to be one that's not a fan of a lot of government regulation either, just simply because it does get in the way of free market space. But at the same time, too, we've seen some free market space get abused pretty heavily. And so, but I do think where the government brings value in that is the ability to bring assurance and insurance into that, right? Like they have with other programs. But I don't think it becomes solely the government. And I think that's part of the thing that, and I'll give Calabria a little bit of credit. In one of the statements he made during the MBA a couple of weeks ago was at the end of the day, his job is to be able to provide an avenue for Fannie and Freddie to get back to private, right? To get outside of the overall thumb or the investment made by Treasury. It's the same. My job is running the mortgage division is to create an opportunity to produce secondary market eligible loans for our bank to sell. It's not for me to build a portfolio of loans. It could be, but it's not, right? And so the bank sees that it's the best course of action and the best way to mitigate risk is for me to originate loans available for sale in the secondary market. So that's what we do. Now, if I could change that up, if I could bring some assurances into my bank, if I could bring the opportunity, whether I'm an independent banker or a true, working for a bank, if I had the ability to have some insurances there and to mitigate the risk, would I be willing to take advantage of stepping into some new areas and doing things a little bit differently, a little bit, maybe integrate more with nonprofits and local organizations to help create opportunities to go into smaller communities and low income spaces? Yeah, definitely. And I think that's what it's going to take. It's going to take the government having to bring some assurance and a little bit of kind of like what Fannie and Freddie were originally designed, draw the box, give us some parameters to play in, but help us cover that risk a little bit and let us know that if we choose to go outside the box or step into a new area that you're not going to hang us out to dry for that. And at the same time, make it profitable, but we don't necessarily, it doesn't have to be one of those that we don't want it to be something we're taking advantage of the public on either. So totally understand that piece as well. But we do need the opportunity to get into new spaces, new opportunities, and know that we're covered. I mean, look, right now, we're not even sure what this new, QM rule is going to be and what that effect is going to have on us, right? So as we're trying to understand, well, shoot, do I want to service loans for the next 3 years to consider it a QM test, or am I going to charge the customer 2.5% more on the rate so that possibly we can cover some of that risk to go over 43%? Or the fact that right now you can't seem to get an AUS approval on a 90% LTV loan with a 670 FICO score. What's the deal? So, I mean, that's one of those deals that ultimately we need to see that change a little bit and bring some freedom back into that so that we can take good customers that can truly repay their loan. I think the residual test is a good little option that they're put in there. If cash flow is there and the customer can truly show the proper management of the cash flow, we should be able to take some additional risk and move into a different area and help with that. And I think that'll help with new construction. I think that'll help with low to moderate income space, the whole 9 yards.
This is the last week in Mortgage Today. Got about 10 minutes left with Chris Sims of People National Bank. And Chris, what you just mentioned, we've been hearing that now from the members. This has been a recent trend these last few weeks that, very well publicized is what you read in the news about the changes with Fannie and Freddie, if it's the 7% non-owner, other things that are potentially coming down the pike. But then there's the hidden changes, the tweaks that they're making behind the scenes to LP and DU that people like you, boots on the ground, are seeing on a day-to-day basis. Like, this doesn't make sense. Like, this is not the decision that would have been rendered 3 or 4 months ago. And just its impact on affordable housing, first-time home buyers, all of the values and virtues that the Biden administration, through their housing policy, is espousing. But the practical matter of what we see happening on the ground is different. You can argue, maybe what makes sense and what doesn't, but it's just an interesting dynamic right now.
It is. It really is. And the lack of communication from Fannie, or clarity, I should say. Now, I shouldn't say lack of communication, but lack of clarity on what's going to truly make a good loan. Because I'll tell you, the amount of times that we're having to go back and rerun a customer who's writing 36 contracts, trying to go 20 grand over list price on a property, and making sure that they can handle those little tweaks to their deal, because God forbid one of them puts them over just a little bit in one thing or another. Next thing you know, they can't get approved anymore. So you want to, that's probably one of the most difficult pieces. I got, our guys are writing maybe 30 new opportunities a week, but out of those 30, you might turn into 8 or 9 true loans. And that's probably the very disappointing fact. The amount of work that's going in, the effort that's going in, the time that's going in, but the ability to make sure these consumers truly have the opportunity to take advantage of buying a house is not there. It's and the guidance we're trying to give them, it's very difficult. It really is. So, and again, the lack of communication that I think we're getting in terms of clarity and how they want us to proceed and what that risk looks like, it's becoming very frustrating, to say the least. So.
Speaking of Fannie, also making news recently, they revised their 2001 projections for originations and housing. Of note, the total origination number for 2021 didn't change too much, expected to be another very good year for the industry, but revised downward fairly sharply their purchase projection and up their refi projection. And this was from their latest revision, which wasn't that long ago. It was kind of like an impromptu revision. It kind of came out in the news and caught some of us off guard. So, but that's, I think, the conventional wisdom right now is, we've been talking about it on this show each week, just kind of trying to figure out how 2021 is going to play out. I think the conventional wisdom right now is more refi than we thought and less purchase, just because of the supply side issues. And then I think we see the Fed is, by all indications, going to keep their foot on the gas pedal in the mortgage bond market. So it seems like it's going to be a low rate year. And then this equity that is being just on a daily basis, if you own a home, it's like, a rising stock. So yeah. The ability for people to take cash out. Is that how you guys are looking at 21 now?
It's funny. We sat on the Collab Lab. So another, and I'll make a little push for the Collab Labs here, right, with TMC. And that became one of the final conversations I think we had that last week was, hey, how are you telling your superiors what you think the volume predictions are going to be? Because I'm really struggling to figure out the math. And that was my response back was, buddy, yours is as good as mine. And your guess is as good as mine at this point in time. Because if I was to truly base it on my refinances, I would have a much better gauge. But right now, look at the amount of volume. I mean, we're 75% purchase volume right now walking in the door in new starts. But in actual loan closings, that's closer to probably 50-50, right? And so because those new loans are not actually going through, they're not able to find a property, or they just get tired of looking, they get outbid 50 million times, whatever. So we are collectively looking at those situations and trying to gauge what the prediction is going to be for this year. I think any prediction is going to be wrong. It really is. And I don't think there's a right number. because until we get clarity on what we know we can approve and how these loans are going to move through, it's very difficult for us to look at our pipeline and say, yeah, I can hedge on this. I can determine if this is going to be a viable, loan basis, and we're going to be able to close X amount and have this amount of fundings. Right now, I think that ultimately trying to determine what those pipelines are truly going to turn into closed businesses is getting difficult to gauge at this point in time until we get some additional clarity. But you're right, rates will be low. I still think refinances will be an opportunity throughout the year. Homeowners that are getting frustrated trying to sell, or better, not trying to sell, but not being able to find something to buy to sell. And then finding out that if we had some little more flexibility back on the construction side, that maybe we could go into and help them renovate, and maybe they could develop that home that they want inside of their existing foundation, but not necessarily have to go find a new build or whatever. And that's been an interesting conversation too. So, ultimately, I do see the refinances being there. I see purchases continuing to be hot throughout the year. And I think the Midwest is going to be the hottest marketplace moving forward for the next 12 to 18 months for sure. Not only because of manufacturing that's coming back in, but like I said, people moving back from the coast and taking advantage of being closer to family and having a little bit more space for less cost for right now.
Will be interesting to see how that plays out. I personally agree with you. So, Chris, you're a guy that has served in leadership roles for independent mortgage banking companies as well as banks. So curious to get your thoughts on just the general competitive climate right now, kind of banks, IMBs, credit unions, in this time of perpetual change and emerging technology, IMBs, stereotyping a little bit, move maybe a little bit quicker. Yet some definite advantages for the depositories as we move forward. If you look just over the course of the next 5 years, the types of products that banks can do better, if it's jumbo or construction or kind of niche portfolio products, much easier for the depositories to do. So some advantages there. Just curious how you view the competitive climate kind of globally in the mortgage industry right now.
I look at it as creativity is key across the board. Rich, you and I have talked about this many times, both of us being in the banking world for quite some time, that, banks ultimately have the opportunity and capacity, as well as, in most cases, the talent to do some pretty cool things inside of mortgage, but are really scared to. And so often don't take advantage of the opportunities they have available to them. And I say that working for a bank and knowing that my bank doesn't want to take some of those additional risks. That if an independent had the same opportunity, they would every day of the week, right? But I do value the fact that the independent side can move quicker. They can be creative. A couple of weeks ago, you were talking to Thrive and Mike Jones and his some of the uniqueness he's done in the construction lending side. You don't see that in the independent world, and he's really done a great job on that and created some. I think those are the things that are going to continue to be unique in the independent space to keep them flexible and moving. They tend to have a much higher cost of acquisition for lead to closing because of them trying to bring in additional technology and being creative that way. So when it comes to a price point, and especially with some margin compression, that gets a little difficult. Not to mention that in many opportunities too, especially around street origination, the expense for commissions alone gets to be pretty high on that side. So the independents have got to pay out quite a bit compared to the banking side that tends to have a little bit more, can usually go in with a little bit less compensation for some opportunities and benefits that aren't necessarily there in the independent space. So I think you're going to continue to see that battle. I wish the banking world would step up a little bit and take some risks that it could really handle. And again, I'll give our bank a lot of credit that they have in many cases for us. But at the same time too, I still think that there's things that the industry as a whole from the banking side could go a little bit farther on too, and would make it a more interesting competitive bid against the independent side. So
never a dull moment in the mortgage industry. It's keep you on your toes. Chris, thank you so much. I always enjoy talking about the industry and housing market with you. Thank you very much for joining me this week.
Thanks, Rich. It's a pleasure, man.
And to our attendees, once again, thanks for taking the time out. We're here every Tuesday at 2 p.m. Eastern for the last week in Mortgage Today. We also upload these videos to our YouTube channel and release them through Apple Podcasts and Spotify as podcasts as well. So until next Tuesday at 2 p.m., have a great week, everyone. Take care.